Hey everyone, it's Matt here from Metals with Matt. Imagine this. Silver just plunged from its recent highs above $100 an ounce down to around $74 today, but Robert Kiyosaki, the rich dad, poor dad legend, is screaming from the rooftops that it's heading to $200 by the end of 2026. That's not hype. That's a contrarian fact, straight from one of the sharpest minds in finance, clashing head-on with the mainstream media's panic about a silver crash. If you're an American investor watching your portfolio in this volatile market, this dip isn't a disaster. It could be the setup for explosive gains in precious metals. But here's why the next 48 to 72 hours could make or break your silver investment strategy. Right now, with the US dollar index hovering around 102 and fresh inflation data showing core CPI at 3.2% year over year, institutional players are quietly accumulating while retail folks like you and me might be tempted to sell in fear. Miss this window, and you could watch silver rebound without you, especially as geopolitical tensions in the Middle East and supply chain disruptions from China tighten the noose on global silver supplies. Don't let fear of missing out, or outright fear, keep you on the sidelines. This is where smart money positions for the long haul in the precious metals market. Stick with me through this entire video because at the very end, I'll reveal Kiyosaki's secret data point on why this deficit-driven surge could double your gains if approached educationally. It's a number tied to industrial demand that most investors overlook, and I'll only drop it after we unpack the full fundamentals. Let's zoom out and connect the dots on the broader macro picture because silver's price today, sitting at about $74 per ounce as of mid-February 2026, isn't happening in a vacuum. Tie it directly to the US dollar index, or DXY, which is currently at around 102.5 after a slight uptick from Fed signals on potential rate cuts. When the dollar strengthens like this, precious metals like silver often face headwinds. But here's the key. Inflation data from the Bureau of Labor Statistics shows US CPI at 2.9% for January 2026, with core inflation stubbornly at 3.2%, meaning real yields are negative for savers. Add in geopolitical events, like the ongoing tensions in Ukraine and the Middle East disrupting shipping lanes, which are spiking energy costs and indirectly boosting silver's role as a hedge against inflation. For US audiences, think about how this ties to your everyday life. Higher grocery bills, rising mortgage rates around 6.5%, silver acts as a store of value when fiat currencies like the dollar lose purchasing power. Historically, during the 1970s stagflation, silver surged from $4 to $50 an ounce as inflation hit double digits. Today, with similar echoes, this dip to $74 could mirror that setup. But educationally, remember, past performance isn't indicative of future results. We're here to understand the connections. Globally, China's export restrictions on silver, announced in January 2026, are reducing available supply by an estimated 10–15% per Reuters reports, while U.S. solar panel manufacturing under the Inflation Reduction Act is ramping up demand for silver in photovoltaics. This macro landscape sets silver apart from stocks or bonds. It's a tangible asset with industrial utility, making it a dual play for investors in uncertain times. Let's break it down further. The DXY's inverse relationship with silver has a correlation coefficient of about 0.7 over the last decade, meaning when the dollar weakens, as it might with Fed easing, silver shines brighter. Geopolitically, events like the recent Houthi attacks on Red Sea shipping have increased insurance costs for metal transports, adding premiums to physical silver deliveries in the U.S. Inflation isn't just a number, it's eroding your savings at a real rate of 0.5% if you're in treasuries yielding 4%. Silver, with its historical average annual return of 7 to 8% over long periods, offers a potential counterbalance. But again, this is educational. Volatility is high, as seen in the recent drop from 103 highs in January to $74 now. Connecting to U.S.-specific events, the upcoming midterm elections could sway fiscal policy, with both parties pushing for more spending on infrastructure, which boosts silver use in EVs and green tech. The macro stage is set for a rebound, but it requires understanding these links to navigate wisely. Now, let's contrast what everyday retail investors like you, folks in Texas, California, or New York, managing their 401ks or IRAs, are doing versus the big institutional whales quietly maneuvering in the background. Retail sentiment, based on recent surveys from the American Association of Individual Investors, shows precious metals allocation at just 5 to 7% of portfolios, with many selling during this dip out of fear, as evidenced by outflows from silver ETFs like SLV dropping 2% last week per Bloomberg data. Meanwhile, the whales, think JP Morgan, the COMEX warehouses, and central banks, are doing the opposite. JP Morgan's commodities desk, which holds massive silver positions, reported in their Q4 2025 earnings that they're maintaining long exposure despite volatility, citing structural deficits. Central banks, per the World Gold Council, which tracks silver indirectly, have been net buyers of precious metals, with the People's Bank of China adding 50 tons of silver equivalents in reserves last quarter alone. COMEX inventories? They're down 15% year over year to about 300 million ounces, signaling whales are hoarding rather than dumping. Why the gap? Retail reacts to headlines like silver crashes 20% in a month, while whales look at fundamentals. The Silver Institute's projection of a 67 million ounce deficit in 2026, the sixth straight year. For U.S. investors, this matters because whales like BlackRock or Vanguard influence your mutual funds. They're increasing silver miner stakes, up 10% in filings. Educationally, this isn't about following blindly, it's about recognizing patterns. Historically, during the 2008 crisis, retail sold gold and silver at lows while institutions accumulated, leading to a 400% silver rally by 2011. Today, with U.S. debt at $35 trillion and deficits projected at 6% of GDP, whales see silver as a hedge against devaluation. Retail might be waiting for $50 silver, but whales know supply from mines like those in Peru and Mexico is only up 1.5% to 1.05 billion ounces, per Silver Institute, while demand holds steady at over 1.1 billion. The gap widens with options trading. Retail favors short-term puts during dips, but whale open interest on COMEX futures shows longs dominating at strikes above $80. In your backyard, U.S. mint sales of Silver Eagles are up 25% year-to-date, but that's retail buying physical. Whales control the paper market, which can suppress spot prices temporarily. Bridging this gap educationally means diversifying wisely, perhaps allocating 5 to 10% to silver for portfolio balance, as suggested by financial planners like those at Fidelity. But always, this is not advice. It's insight into the disparity driving market moves. All right, let's roll up our sleeves and dive deep into the evidence chain that supports why silver's current dip to $74 could be a pivotal moment based purely on supply-demand fundamentals, mining data, and warehouse inventories. All real, verifiable facts from trusted sources like the Silver Institute and USGS. Starting with supply, global silver mine production is forecasted at around 850 million ounces for 2026, up modestly from 2025, but total supply, including recycling, hits 1.05 billion ounces, a 1.5% increase per the Silver Institute's latest report. That's the good news for bears, but here's the chain. Over 70% of silver comes as a byproduct from copper, lead, and zinc mines, making it inelastic to price changes. Miners don't ramp up just for silver. Key producers like Peru, 140 mas, Mexico, 120 mas, and China, 110 mas, face challenges. Labor strikes in Peru reduced output by 5% last quarter. Environmental regulations in Mexico cap expansions, and China's export curbs since January 2026 limit 20 to 30 million ounces from hitting global markets. Recycling supply? It's price sensitive, up 3% to 200 mas, but still not enough. Now, demand side. Total silver demand stabilizes at about 1.12 billion ounces in 2026, with industrial use at 650 million ounces, down 2% from peaks due to high prices substituting in some electronics, but up historically. Break it down. Photovoltaics for solar panels consume 200 mas, a 15% rise year over year driven by U.S. Inflation Reduction Act subsidies pushing solar installations to $40 annually. Electronics and EVs, 150 MAHs, with Tesla and Ford ramping silver use in batteries and wiring. Each EV needs 1 to 2 ounces. Jewelry and silverware, 250 MAHs, steady but with U.S. consumers favoring affordable silver over gold amid economic uncertainty. Physical investment, surging 20% to 227 MAHs as Americans buy coins and bars. U.S. Mint sold 2 million silver eagles in January alone. The chain links to a deficit, 67 million ounces shortfall, 6th consecutive year, eroding above-ground stocks. Warehouse inventories, COMEX at 290 MAHs, down 20% YY. LBMA in London at 1.1 billion ounces, but with 30% allocated to ETFs like SLV. Historical data? From 2021-2025, deficits totaled over 500 MAHs, drawing down inventories to multi-year lows. Mining data. Average all-in sustaining costs, AISC, for primary silver miners like Pan American Silver or Hecla are $15.20 Oz, so at $74, margins are fat. But exploration budgets only up 5% per S&P Global, meaning future supply growth lags. Evidence from USGS. U.S. silver reserves at 25,000 tons, but domestic production just 1,000 tons annually, making imports critical, vulnerable to tariffs or disruptions. Chain to price. Deficits historically correlate with 20–50% annual gains, like 2010's rally. But educationally, volatility cuts both ways. 2022's 15% drop despite deficits. Let's expand. In photovoltaics, silver paste usage per panel dropped 10% via thrifting, but overall demand rises with global solar capacity hitting 1 TW by end 2026. EVs, silver in contacts and switches. GM's Ultium platform uses more per vehicle. Investment, bars and coins up 25% in North America per CPM Group. Supply chain, top mines like Penasquito, Newmont, output flat at 30 MAHs due to water issues. Recycling, from old solar panels, but only 10% recoverable efficiently. Inventories, Shanghai Futures Exchange stocks down 40% to 50 MAHs. This evidence chain builds a case for resilience, but no certainties. Markets evolve. Now, you might think this deficit evidence chain paints a purely bullish picture for silver, pushing prices relentlessly higher from this $74 dip. But here's the plot twist pivot. There's a hidden trap lurking in the COMEX warehouses and industrial substitution trends that could cap upside or even trigger short-term pullbacks, even as long-term fundamentals scream opportunity. Let's unpack this counter-argument educationally. First, the warehouse trap. While COMEX inventories are low at 290 million ounces, a chunk, about 40%, is eligible but not registered for delivery, meaning owners could flood the market if prices spike too fast, creating artificial supply pressure. Historically, in 2011 when silver hit $49, JP Morgan, a major custodian, allegedly manipulated via massive shorts per CFTC investigations, though settled without admission. Today, with open interest at 150,000 contracts, 750 MAHs equivalent, a similar setup exists. If whales unwind positions, it could suppress spot prices below fundamentals. Plot twist deepens with industrial demand. At 74 plus, substitution accelerates. Companies like First Solar are testing copper-based alternatives in solar, potentially slashing 20–30 MAHs demand by 2027 per Wood Mackenzie. Electronics firms switch to graphene or aluminum in circuits, reducing another 10 MAHs. This isn't immediate, but it's a trap. High prices cure high prices by curbing demand, as seen in 1980 when Hunt Brothers' squeeze collapsed under substitution. Counter to the bull case, bearish analysts like those at Capital Economics forecast silver averaging $70 in H2 2026 if Fed hikes rates, strengthening DXY to 105 and pressuring metals. Geopolitical de-escalation, say a Ukraine ceasefire, could ease energy costs, boosting mine output by 2 to 3%. Mining twists. New projects like Escobal in Guatemala face delays from community protests, but if resolved, add 10 MAHs supply. Recycling trap. Higher prices incentivize more scrap, potentially adding 50 MAs if urban mining tech improves. ETF outflows. If stocks rally on AI hype, silver ETFs could see redemptions like 2021's 100 MAs exit. This pivot isn't to scare you, it's educational balance. Bulls see deficits driving 100 plus, but traps like these remind us volatility is king. Real data. Silver Institute notes industrial demand down 2% in 2026 due to exactly this substitution. JP Morgan's $81 average forecast embeds this risk, lower than Kiyosaki's $200. Twist to opportunity. Savvy investors use dips to accumulate, knowing traps often resolve bullishly long term. Stop. Listen to me carefully on this next point, because this is where most people lose money. And just a quick friendly reminder here in the middle of our deep dive. This video is for educational purposes only, sharing real market insights to help you learn. I'm not a financial advisor, so always do your own research and consider consulting professionals before making any investment decisions. It keeps things fun and informed for all of us. Shifting gears to market psychology, let's give a realistic best case and worst case scenario for silver in 2026, grounded in facts to help you navigate the emotional roller coaster that precious metals investing can be, especially for US audiences dealing with economic headlines daily. First, the bull reality. In the best case, deficits deepen beyond 67 MAs if industrial demand surprises higher. Say, US EV sales hit 2 million units under tax credits, boosting silver use by 20 MAs. Kiyosaki's $200 target plays out if inflation resurges to 4%, weakening DXY to 95, and central banks diversify more into silver, currently minimal, but PBOC hints at it. Miners like First Majestic see production costs drop with energy efficiencies, but supply lags, pushing prices to 150-plus averages. Historical parallel. 2008-2011 bull run saw silver quadruple amid QE. Psychology here, euphoria builds as retail piles in, but smart bulls take profits at peaks. Now the bear reality. Worst case, substitution slashes industrial demand by 50 MAs, and mine supply jumps 5% from new tech and extraction, e.g., AI-optimized drilling. If Fed tightens to combat sticky inflation, DXY hits 110, crushing metals. Silver could test $50 lows, as some scenarios warn. Geopolitical calm reduces safe haven bids and ETF outflows of 100 MAs flood markets. Psychology trap, fear selling at bottoms, as in 2022's 30% drop. Reality check, most likely a middle ground, $81 average per JPM with volatility. For Americans, this ties to personal finance. Bulls hedge against 7% credit card rates. Bears wait for clarity on jobs data. Unemployment at 4.1%. Educationally, psychology wins. 80% of returns come from discipline, not timing. Diversify, don't bet the farm. So, based on all this educational breakdown, are you buying this silver dip around $74 or waiting for it to potentially drop back to $60 or even $50? Tell me in the comments below. I'm reading every single one, and let's build this community of informed US precious metals enthusiasts sharing real insights. All right, you've stuck with me. Time for the grand reveal of that secret data point I promised in the hook. It's tied to industrial demand, and here's the number, 200 million ounces. That's the projected silver consumption just for photovoltaics in 2026, per Silver Institute estimates, representing a 15% increase and a key driver why this deficit could persist, potentially setting up for gains that double from current levels if market conditions align, as Kiyosaki warns. This isn't widely discussed, but it's the solar silver surge fueling the bull case educationally. So, what's the move for today in this educational lens? Patience is the real silver bullion right now. Focus on accumulating knowledge about deficits and demand, perhaps considering diversified exposure through miners or physical if it fits your research, but always with risk management in mind for long-term hedging. Don't let the market manipulators win. Subscribe to Metals with Matt for the daily truth on precious metals. Hit that like button if this educated you, and turn on notifications so you never miss an update. And one last friendly note before we wrap. Remember, All this is educational content based on public data. Past trends don't guarantee future results, and I'm not providing investment advice. Do your due diligence, stay informed, and invest responsibly to keep your financial journey safe and exciting.